Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
55th all-time high. Stocks notch another record. Fed Chair Powell sets the tone today. Political drama from Asia to Europe, a call for the president's impeachment in South Korea, and France braces for a no-confidence vote. And the OECD warns global stability under threat. The chief economist, Alvaro Pereira, joins us later this hour. Good morning, Manus.
Danny, good morning. Check in on that 55, knocking on the door of 56, maybe 56 record highs today. Let's see how we trade out. A quarter of 1%, $11 trillion in value has been added in 2024. Yeah, the skew is completely one-sided, according to Citigroup, but if you believe in U.S. exceptionalism, as Barclays' Emmanuel Cao does, it will extend into 2025, led by cyclical and value stocks, is his view. Roll it over, have a look at the bonds. Again, I wonder to what extent do bonds, if at all, can play a role in the political chaos that we see in South Korea or the French risk. We'll talk more about that through the show. Yields pop higher by 2 basis points this morning. Powell speaks today at the New York Times Deal Book Summit. That indeed will capture the tone. Don't forget, November the 14th, he said move carefully. Roll it down, have a look at the Korean won. We are in the throes of an impeachment call from the parliament yesterday, which was what you can see the spike higher in the dollar, down in the won, which was when the martial law was implemented. Then it was withdrawn after 6 short hours. Danny, we've undone 50% of the losses yesterday.
Well, it just really underscores the fleet of U.S. assets, whether you look at the dollar, whether you look at stocks at 55 all-time highs. Also talking about growth, but have we really priced in the worst of what we could get next year, i.e. tariffs and inflation? Sam Lynton-Brown, head of global microstrategy at BNP Paribas, argues no, pointing to 5-year break-evens, that they are still not high enough to price in what we could get next year, still below 2.4%. I'm pleased to say that Sam joins us now again of BNP Paribas. So Sam, what would it look like to price in tariff risks for next year? What should this chart appear to be?
Good morning, Danny. Good morning, Manus. 5-year inflation expectations in the US, as you point out, right now are at 2.4%. We don't think that takes Trump seriously or literally enough in what he's saying on tariffs. There's usually a 30 basis point difference between CPI, that inflation break-evens are based on, and the Fed's inflation target PCE. Put differently, at 2.3%, 2.4% in 5-year inflation expectations, that means the market prices in the Fed hitting its inflation target on average over the next 5 years. We simply think that's too complacent. It's not pricing in enough inflation risk premium associated with Trump and tariffs.
With that as your base case, Sam, how do you see the progression? The narrative from the Fed speakers over the past couple of days was still erring towards a December cut. But if you think we're underpricing the tail risk of an inflation renaissance, then how much shallower and shorter will the Fed's cutting cycle be in 2025 for Paribas?
We expect the Fed to cut in December, and I think what we've heard from Fed speakers recently, in particular, I'd flag Waller, is that the burden of proof is on the data over the next couple of weeks, in particular payrolls and the inflation data that we'll get to surprise on the upside, in order for the Fed not to cut in December. I think the key, though, is if we think about, for example, the summary of economic projections, we'll also receive those in the December meeting. What they might show is that some FOMC participants are beginning to incorporate tighter control of the borders, tariffs, on their forecast for the economy as well. And that could be reflected in slightly higher inflation, lower growth, and in turn projecting fewer Fed cuts for next year.
Hang on, Sam, if I can jump in there, because that's an important point, because to this point, the Fed has avoided talking about the politics at all, saying that they're going to handle it as it comes in. Do you expect them to head-on address what the political economy is going to look like next year?
We don't expect Powell to say anything direct about it in the press conference. We'd expect a similar line to what he has been following recently, which is we can't react before things actually occur. But in practice, the Fed are having to deal with risks. And so they need to be very mindful that if they cut rates too much too quickly, and then there is an inflation shock, a negative supply shock effectively from tariffs, that they run a risk of inflation being too high and potentially that having a feed through to expectations. So I think what we'll see in the summary of economic projections is that each FOMC participant is effectively making their own assumption on the path for policy that might, and the path for, I should say, tariff policy, border policy, which in turn will create quite a confusing message, I think, from those projections, as not everyone will be incorporating the same assumptions into them.
How much more aggressive can 2025 be relative to, let's say, 2016, 2017, 2018, when the tariffs really rolled higher?
The timing here is very difficult to pinpoint, as you point out, Manus, as there's clearly a lot of policy uncertainty, both in terms of actual implementation and when that implementation might occur. I think from an investing perspective, what that means is that as one looks to hedge inflation risks, we would advocate doing so via slightly longer tenors, for example, 5-year, rather than shorter tenors that are going to be extremely sensitive to the actual timing of when tariffs get implemented. I think, again, pairing a view that inflation expectations are underpriced, that tariff risk is underpriced, pairs quite nicely as well with a bullish dollar stance.
Sam, it has been this moment where we're contemplating a global rebalancing and the pain that might cause, whether it be from the U.S. and tariffs or looking at the political drama abroad in South Korea, reminding us how important that country is in the supply chain and what it could mean in the upheaval we might get for next year. At what point does that stop being U.S. dollar and U.S. asset positive? Is there a point where it crosses a threshold and is bad for American assets?
On the face of it, it looks like uncertainty globally is rising. Yet, as you were just pointing out, the S&P is printing quite an impressive run of consecutive all-time highs and vols falling. So for now, the market doesn't seem very concerned, at least as it pertains to US risk assets. I think certainly across the course of next year, there are going to be moments when that narrative shifts and shifts very suddenly and the market does become more concerned. But I think for now, it seems the market's quite comfortable to price a growth boost from deregulation and is a bit less concerned about the negative growth impacts of less labour supply into the US and also the negative growth impacts that might come from tariffs. For the relative story here, I think this is where currencies are key because naturally that's always a relative play, and I think it all really favours the dollar.
Well, Sam, where do you come down? Because I know Danny was debating this with a number of guests yesterday. There was a great article in the FT talking about American assets on the equity side. Over-owned, overvalued, and overhyped as never, ever seen before. Now, can that translate? I mean, that's the equity story, but that can, to a certain extent, translate into the dollar. A number of people are saying it's very stressed, overloved, and over-owned. It was actually Mujeres Sharma, excuse me.
Yeah, I think many people have had that view for both the US equity market and also the dollar for quite some time, but they probably would have had it at the beginning of this year and perhaps the year before that as well. And the secular trend seems to really be quite strong there. I think as it pertains to the currency, it is true. The US runs a large current account deficit. That means in order to finance itself, it requires foreign investors to put money into the US through building factories or through buying companies and also through buying assets, bonds and equities. I think the risk to the dollar would be if at some point the market was concerned around the Fed's independence, then you could see a very significant repricing higher and steeper in the US curve, and that could also be associated with a weakening of the dollar. But I think provided that's avoided, then the US should be quite comfortable in funding that current account deficit.
Well, let's see whether Mr. Bessent does float the idea of a shadow chair on the Fed. That could be a bit of a dislocating moment for the dollar. Sam, thank you very much. Sam Lynton-Brown there of BNP Paribas joining us this morning. Let's get you some other stories trending on your Bloomberg terminal this morning. Salesforce reported quarterly revenue that topped analyst estimates, boosting investor hopes that AI will boost results. The company pivoted its strategy to focus on tools called agents, which are designed to complete the tasks such as customer service or sales development without human supervision.
Elsewhere, people familiar are telling us that the $60 billion proposed management buyout of Seven & I will include plans to IPO its U.S. assets. That's intended to help ease financial concerns. Seven & I intends to retain a stake after any potential listing.
President-elect Trump is considering Florida Governor Ron DeSantis as the possible replacement for Pete Hegseth. That's to run the Pentagon, according to the Wall Street Journal. This comes amid Republican senators' concerns over mounting allegations about the former Fox News host's personal life.
Coming up, the OECD warns of dangers from trade tensions to debt. We're going to catch up with the Chief Economist, Alvaro Pereira, who will be joining us next on Bloomberg Brief.
While overall, this economic outlook shows a resilient picture, significant risks and uncertainties remain. First, geopolitical tensions and conflicts remain a key concern. Second, pressures are rising on global trade. Third, high public debt creates significant vulnerabilities. Rising spending needs related to population aging, defense requirements, climate action, and other structural pressures will likely increase pressures on debt sustainability.
And that was the OECD Secretary General Matthias Gorman there speaking just an hour ago about the risks facing the global economy in the coming year. For a deeper analysis on those risks, we're joined now by the Chief Economist for the OECD, Alvaro Pereira. Alvaro, good morning, sir. Good to have you with us. When we look at some of the warning signs we'll talk about those.
Good to be here.
Great to have you with us. We'll talk more about those in just a moment. But you project strong growth, 3.3%, and inflation falling. How much certainty do you have in these projections? Because the tail risks are significant for 2025 and 2026.
Well, we remember it's important to put things into context. In the past 5 years, we had a pandemic, which led to a lot of lockdowns and a huge economic disruption. We also had the biggest energy crisis in many countries since the 1970s. And in spite of these two shocks, the world economy continues to have a very good performance. We're talking about this year 3.2%, next year 3.3%. And so we think that there's a lot of good things happening in the world economy. I would like to highlight two things that I think is important. First, the United States, close to 3% growth now and close to 2.5% next year. And this is mostly because of investment and something that we really like, which is productivity growth. And we think this is possibly related to the AI, so we can come back to that if you want. The second part is that many EMEs are doing really well. India growing close to 7%. We have Brazil growing 3%, and many other countries doing fairly well, like Indonesia. So we think there's good reasons for us to be positive about the world economy. We highlight the risk because obviously an escalation of conflicts could disrupt the world economy, and we think that what we've seen in the past 15 years was a steady rise in protectionism and import measures, restrictive measures. And so we think that obviously if there's an increase in this trade protectionism, this will have an impact on trade and growth.
Alvaro, you've already seen unrest and changes sweeping throughout different governments, and you in your report point to significant differences throughout regions. Yes, there was resilience, and there has been resilience in this global economy, but where do you see that falling short? If we have President-elect Trump putting in sweeping tariffs, what regions might not have that same resilience as we've been used to in the past?
So I'm not going to comment on policies that have not been legislated or announced. We're talking about promises that were done in an electoral campaign, and so I don't think it's appropriate to comment. What we think is important to say is that continuing and fostering dialogue between countries is absolutely essential. What we know about trade is that trade in the past few decades has led to more than 1 billion people getting out of poverty. We saw significant growth of the world economy partly because of world trade. So we think it's important to keep the dialogue open between countries so that we get good agreements and we keep the open markets going forward.
Alvaro, you talk about the strength in the United States, investment and AI, but to what extent is that strength and exceptionalism in the US going to be driven by full deficit implementation and the promises that President-elect has made over the AI proposition that you put on the table?
Well, on the fiscal front, we highlight that it's absolutely essential for the United States to have a medium-term plan to be able to put debt on a downward trajectory. Right now, debt continues to be high and it continues to rise, and we think that it's very important to work on the fiscal front. On the AI, I would like to highlight, this is what I'm saying. The last 2 or 3 years, we've seen productivity growth being fairly robust, A recent paper from the OECD shows very clearly that in the next 10 years, we expect, when you look at different sectors, that AI might have an impact on labor productivity between 0.4 and 0.9% per year. And this is very consistent with what we see in the numbers, where we had productivity growth around 1%. Now we're having close to 2%. And we think this is related to AI. Why do we think that? Well, not only because of this paper and estimations that we had, but also we see that a lot of the investment that we see in the United States is exactly happening in the ICT sector or related to AI. And so because of this big investment, this is boosting productivity as well. And so I think there is a good chance that we have the United States continue to be a very robust economy going forward.
Elsewhere, though, Alvaro, not far from where you are in Paris, the National Assembly is going to be preparing for a no-confidence vote for this current government. We're at a time where there's political upheaval, not just in France, but in Germany, really the core of Europe, when it used to be the periphery that was the problem child. This change, this upheaval, how big of a threat is it to the wider European economy?
Well, obviously, Germany growing, almost no growing this year. It's a source of concern. We expect that Germany will grow around 0.7% next year and do a little bit better in the following year. But we still think that Germany needs to undertake several structural reforms to make it more competitive, not only to boost the labor market and the growth potential by fostering, for example, female participation and also fostering the integration of some youth and older workers back into the labor market, but also undertaking reforms to, especially in the service sector, where we think there are still too many barriers to competition and entry. So those are areas that we think that Germany should focus, together with investment in digital infrastructure, which Germany is behind many OECD countries. With regards to France, we've been highlighting for many years that spending is fairly large, and in fact, we see that the deficit right now is large, and that trajectory continues to be upward. So we think that going back to fiscal discipline is essential for France to address these issues. So we believe very strongly that the next few years is crucial to have a medium-term plan to have fiscal discipline and to bring that back on a downward trajectory. So I think that's the essential part that we should focus, independently what the government we're talking about.
Alvaro, thank you for being so kind with your time this morning. That is the OECD Chief Economist, Alvaro Pereira. All right, coming up, as we've been talking about political turmoil taking over, we're going to discuss the unrest in both France and South Korea coming up. You're looking now, live pictures of Seoul, South Koreans there out on the streets. You can see some of them holding signs calling for the president to resign. Opposition parties have also called for an impeachment of President Yoon. Again, we'll have the details for you after this break.
Good.
This political event was very short-lived, and I do not see any reason why it has to change our economic outlook at this moment. We are still, at this moment, stick to our forecast, but I believe that our growth forecast will be more impacted by the structural factors.
The governor of the Bank of Korea there praising the stability of markets in the face of political turmoil in South Korea, where opposition parties have submitted a motion for President Yoon's impeachment after he shocked the world by declaring martial law. The defense minister this morning also offering to resign and apologizing for causing confusion. Joining us now is Bloomberg's Katya Dmitrieva. Katya, at one point, the won fell by more than 2.5% versus the dollar. We've undone most of that. But are there any lasting impacts from the past 24 hours?
Yeah, as you noted there, the currency sliding. We also had the cost be down more than 1% on the day. So those are sort of the short-term impacts, as well as all the mayhem we saw on the streets of Seoul kind of overnight last night and into this morning. More long-term, and sort of the answers we don't have right now are also a lot of the important ones. So what's going to happen to consumer sentiment? business investment going forward, because amid all of these impeachment proceedings, that'll be over the next 24, 48 hours, but then who will be the leader after that? The actual impeachment process itself can drag on for a few months. So that will put a damper on spending. People will be more likely to save. And there's no clear candidate who would be the next president. So kind of the next 2 days will be very important to watch to see what those impacts would be.
Okay, well, certainly we'll be focused on that and on the currency. Of course, President Yoon, his popularity the lowest since he was appointed, and that's back in 2022. Katya, thank you very much. Katya Dmitrieva there on the South Korean situation. Political turmoil continues around the world. To France, lawmakers are gearing up to hold a no-confidence vote there later today on President Macron, urging a rejection of the call, so the government doesn't topple. Joining us now is Caroline Conan at from the National Assembly. Caroline, it's going to take pretty much a miraculous moment from the Barnier method to negotiate his way with Marine Le Pen. Macron is in Saudi Arabia. He's not even in France at the moment.
Macron is in Saudi Arabia, as you mentioned. He's coming back supposedly tonight. We don't know exactly what time, but perhaps around the vote of no confidence, which is supposed to happen behind me in the National Assembly. The debate starting at 4 p.m. French time.
Okay, Caroline,
that's around
thank you very much.
ET.
That is Bloomberg's Caroline Conan outside the National Assembly. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
55 all-time highs. Stocks notch up another record this year as investors await remarks from the Fed Chair Powell. Political drama from Asia to Europe. South Korea's opposition parties call for impeachment of President Yoon. France braces for a no-confidence vote. And investors get another shot of AI hope. Salesforce gets a boost from their earnings. Top the street's estimates. Danny, good morning. 55 records in a row. Can we push it out to 56?
Yeah, and Salesforce helping out tech stocks this morning. You can't see them there, but the Nasdaq is outperforming by 0.5%. The S&P up 0.2. Your 10-year yield, that pushes higher too. There's an intraday sell-off for bonds yesterday. JOLTS showing tighter labor markets than expected. Those leaving jobs the highest since 2.1%. And the dollar is still stronger, Manus, in this environment where global chaos and U.S. tariff expectations, all that does is just feed back into the U.S. dollar.
Yeah, it's interesting. It is the dollar that's ground zero for the reaction function on the geopolitical front. Last week, it was the bond market that was perhaps a little bit more of a receptor of defense. But this movement in the won, and the question becomes then, how much of the political chaos in France is priced in to the euro? If you look at some of the options market, it's going to be pretty hard to get to parity. And a lot of our guests have already said, look, a lot of negative news is already in there.
Well, yeah, and it matters if it moves the ECB, and it doesn't seem like at this point it would influence them at all. I do think it's sort of an interesting threshold. At what point do you get not just a dollar bid, but a treasury bid to get that haven bid? We haven't seen that because the U.S. economy is still so strong. Now, even though that's really fueled dollar bets, our next guest does write that they've downgraded the U.S. dollar view through year-end, reflecting the large buildup of positioning and stretch read across our short-term fair value models. That is Mark McCormick, who's joining us now, Global Head of FX and EM Strategy at TD Bank. Mark, even though you've downgraded your short-term dollar view, everywhere else in your research, you give reasons to be bullish the U.S. dollar. So any sort of pullback, how short-lived might it be?
Yeah, I would say in terms of talking pullback here, we're talking weeks. These type of indicators like positioning, short-term fair values, these guys have a half-life of under a month. So this is kind of our expression through our weekly dispatch, and it's just a way of kind of articulating a trading stance that, as we go into year end, there's a lot priced in. If we look at our positioning indicators, we've seen over a 1 standard deviation move in the dollar. Pendulum has basically gone from, the weakness in U.S. data, the Fed pricing. We've swung all the way back to the other side where our models are actually, very long the dollar, and it looks stretched. But that's a very different strategy than thinking the next 3 months, the next 6 months. So it's more of a technical understanding of the markets, and people like to look at charts and they like to look at certain technical indicators. We use models that kind of help us understand technical signals. And we incorporate that into our short-term view. So I would say this is a view to think about in terms of the next couple of weeks.
I think when I had HSBC with me last week, they said, look, if the dollar was an equity, it would be a hold for them right now. When we look at the confluence of factors supporting the dollar and driving it, one is asset exceptionalism, one is rates, and one is geopolitical risk. And when they're eye of the storm of geopolitical risk in France and South Korea. But if there is some kind of a reduction in Middle East risk and Russia risk, Mark, that huge leg of the geopolitical stool, what would that do to the dollar?
That one's interesting. I think it provides a little bit of a cushion for the euro. Again, our forecast is for 101, which is basically a hit of parity early next year. I think the key thing that's like come through in the Middle East and what's come through on Russia is really an energy story. And so energy actually hasn't really moved a lot in the last couple of months anyway. The bias has been a little bit more weaker on the energy prices. So that has not obviously provided too much of a support to the euro. I think, again, I have to bring it back to, one of the things is the U.S. economy is still quite strong. So, again, the context of where we're going here is if we get deregulation, tax cuts, growth policies, all these things, like core PCE is still above target. We're basically landing here around 2.5%. So if Trump can find a way to stimulate the economy while inflation's above target, it's still a higher for longer Fed. We still look for the Fed potentially have to pause in the early part of next year. So the dollar has the carry story. You get the equity story. And whether or not the ECB has to move a lot, you're already going to see rate differentials move against the euro. So I feel like, again, one of the burden of proof for the euro is there a reason to buy European equities? Is there a reason to put further investment allocation into Europe relative to the US? And to me, none of that is actually fully priced in. And again, while we're talking about positioning short-term valuations, those things kind of show, again, where the market swings on a short-term basis. But from a medium-term perspective, I don't see anyone kind of downgrading the outlook for the U.S. to say now it's time to be overweight European assets.
Well, when it was 2016, heading into 2017, there was this assumption that Trump comes in, it's bad for emerging markets because of all the tariffs. Mark, it didn't quite play out that way. And I wonder if this coming year is going to be the same. You're talking about all the growth positive policies to come into the U.S. Is that going to be something that just benefits the global economy wholesale, that the peso, the yuan, currencies like that can benefit from American consumers continuing to buy?
It's going to be interesting, right? Because I think what we're going to see is a bit of a rotation. We kind of think about FX in sectors, or we call them factors, and there's different factors that work in different market environments. The one factor that everyone's been focused on for years has been EM carry. I think what's going to be challenging is that is a story that kind of looks at EM carry, and I think the problem is all the things we've seen this year is the geopolitical uncertainty, the higher macro volatility that's associated with that, the uncertainty that's coming through everything that we're seeing. These are all pieces of the same story. If you think of South Korea, if you think of France, if you think of Germany, think of what's happened in the U.S., this is a rejection of the incumbents. This is part of the geo-macro framework that we're kind of underpinning in terms of how geopolitics interacts with markets. So to make a bullish case for EM, you have to make a bullish case for carry and FX. And I don't think that's where we're going. I think you can make a bullish case for certain currencies in EM. And our view is actually in the second half of the year that EM Asia and also the yen, which represent the most value, are the currencies that will actually do well because China has a lot of dry powder. They can stimulate their economy. We are going to see rate cuts. The Bank of Korea basically surprised with a rate cut last week. So essentially, there is room here that there is a value rotation that can happen in Asia. But I don't think this is a broad EM trade. I feel like EM carry is still going to underperform. We've been seeing it across our factors and models that EM carry is kind of a loser here. And again, if you're offered higher carry from the U.S. dollar, there's not a compelling reason to go into the Mexican peso or to be in the Brazilian real right now, or other currencies where the Sharpe ratio, the volatility adjusted returns, just aren't as good as the U.S.
Well, you've got multiple calls on the yen to be long the yen against the euro and a number of other G10s. You mentioned China there, and you do say that the dollar strength will be the weapon that forces China and America to come quicker to a rapprochement in the trade deal. I just wonder, in that process, Mark, will the PBOC, will the Chinese permit as much of a devaluation as they did back in 2018?
We think there are going to be limitations to how much they let the currency devalue. Our actual official forecast is for 745. I think part of this is, again, the game here is confidence. So the currency is a reflection of national confidence. And I don't think, while some people I think might be looking for dollar China to move 7.75, maybe 8, if there's an aggressive trade war, we think they will find ways to limit how much the renminbi depreciates, either through injecting swap lines through the banking system or job owning or using the fixing rates. We don't think we're going to let the currency go, using kind of air quotes there. I think, again, the primary currency that's going to feel the much of the pain here will be the euro. Again, there's as we see, the French government is on the verge of essentially a lot of challenges. And again, we don't have elections in Germany till February. So again, we have a lot of uncertainty. And again, if we look at the data, we're all still data dependent. The data in the US is still better than all the other places that we're tracking. So again, I feel this is still partly a macro story. There's still a geopolitical angle to it as well. But I feel like the key thing that Trump introduces is macro volatility into either FX rates or relative equity. So again, I think kind of the key thing here is there's going to be limitations on how much dollar China can move, which means if you want to trade some of these global themes, you're going to have to go more into the euro. And again, this is why we like the euro versus yen, because there's a reason here that the yen should be a lot stronger, whether it's through local political incentives or global political incentives to find ways to strengthen the yen.
So, Mark, it all begs the question, what are you more confident about next year? The dollar's strength or Chelsea being able to stay atop near the Premier League table?
I have more confidence that Chelsea will do better than the Chicago Bears, and the dollar will outperform the Bears.
I hope no Chicago fans are watching Manus.
Always good to round off with a little bit of sport. Mark, great to see you this morning. That's Mark McCormick over at TD with his calls on football, American sports, of course, the Euro. We'll be with you in just a moment. From New York, good morning. It is Bloomberg Brief. I'm Manus Rennie alongside Danny Burger here in New York. To France, the lawmakers are set to hold a no-confidence vote later today, with President Macron urging a rejection so the government doesn't topple. Joining us now, it is Caroline Conan from the National Assembly. Caroline, it looks like this train, the TGV political train, has already left this station. The no-confidence vote will come. The question is there anything at the last moment can pause this?
President Macron, as you mentioned, from Saudi Arabia, actually called for lawmakers to wake up and not topple this Barnier government. But it does seem that this Barnier government is living his last few hours. In 4 hours, the debate on the vote of no confidence starts right here behind me at the National Assembly. And even though Michel Barnier said on the 8 o'clock news last night that he had some hope still that his government would survive, there is indeed very little hope, given the national rally of Marine Le Pen has already said they will support the no confidence motion from the far left. So it does look like Michel Barnier could be the shortest lived prime minister of the Fifth Republic.
So take us what happens in 4 hours' time after that debate, after that vote. What's next, Caroline?
This is what's next. President Macron already preparing for what's happening after Michel Barnier, because technically he's going to have to name a new prime minister very quickly. Last time he took 2 months to choose a prime minister after his party lost the snap elections in July. This time, at least his entourage is saying he's going to have to act much quicker to reassure the markets, to try and find a compromise, to try and ensure that we can actually find some kind of stability in this country. So some people are actually talking about the next 24 hours for a new prime minister if there is a collapse today. Obviously, some names are already circulating, like we had last time of the summer. You know, Bernard Cazeneuve, the former socialist prime minister. In fact, the socialists may hold the key. I was just bumping into the former president, François Hollande, last hour, and he didn't want to talk to Bloomberg quite yet, but, you know, there might be a center-left coalition. That might be the key for the next government.
It's who knows who comes back from the political backwaters. What does Marine Le Pen get here? She, in some ways, is partly responsible and driving this political chaos. How do the people of France look at her at the moment? Does she gain in this game?
It's actually very interesting because a lot of her electorate are actually wondering what's going on. Is this rational? Is this rational to have so much instability, at least in the short term? As you know, she is facing a potential ban from running for office for the next 5 years in this trial on embezzlement on EU public funds. She's going to have the verdict on that at the end of March. So a lot of people are saying she's not exactly behaving rationally, but she does have to answer to some of the demands from her electorate, including, of course, pensioners. And she did ask Michel Barnier repeatedly to increase pensions as soon as January, and the government didn't want to compromise on that.
Caroline, we really appreciate your time this morning. That is Bloomberg's Caroline Conan outside the National Assembly in Paris. Meanwhile, here in the U.S., President-elect Trump changing some of his cabinet picks potentially. The Wall Street Journal reporting that he's weighing Florida Governor Ron DeSantis to run the Pentagon. That would replace his previous pick, a controversial one, Pete Hegseth. Joining us now from Washington is Courtney Rosen of Bloomberg Government. Courtney, does this show that potentially Trump doesn't have the blank check to put whoever he wants into his cabinet, that there are some moderating forces, especially in the form of the Senate?
It's certainly a signal that that is accurate. The Republican Party will have a majority in the Senate beginning next year. They'll have 53 seats out of 100. So they have some room for wiggle, right? Where a couple senators may not agree with a nominee, but they can still move that person forward if Democrats, none of them want to go for that person. But this is a test. We saw that with Matt Gaetz, the president-elect's nominee for Attorney General a couple weeks ago. A test of whether the Senate will push back or the Senate will go with what the president-elect wants in 2025.
Well, people are withdrawing, but, people are being pushed aside, one or two, we know that. But talk to us about the DEA pick. He's stepping aside himself, Chad Chronister. He has decided to withdraw.
He was picked to lead the Drug Enforcement Administration, and they deal with a lot of geopolitical issues. He has a local background in local law enforcement in Hillsborough County, Florida, which is in the Tampa area. He was in charge during March 2020, if you remember, when cases were increasing rapidly in the United States, and leaders were asking people to stay home, to not gather together. And he enforced that kind of public health restriction at a church when he arrested someone for holding church services in March of 2020, big gathering of people that wasn't good for health at the time in terms of containing COVID. And so he was criticized for that on the far right. He didn't, when he withdrew his nomination, outright say that that was the reason, but that criticism was definitely existing in the last couple of days.
Courtney, thank you very much. Courtney Rosen on the very latest picks for Cabinet. Salesforce is surging this morning, Danny. We've got some pretty big moves, and this is about a change in policy and direction, isn't it?
Yeah, I mean, nearly 14%, and the change might be just the hype around AI itself for Salesforce. Joining us more on the story is Bloomberg's Tom McKenzie. Tom, what is behind this boost?
Well, you're right. Look, there's been a change in terms of the direction that's been coming through for the last few months for Salesforce in terms of the job cuts, the efficiencies. They were under pressure from some of their investors to do that, Mark Benioff and team. They invested, though, in Agentforce, so an AI agent that they're pushing out to their customers, and it seems to be paying off. To your point, the sales were a beat, the margins were a beat, the outlook as well for the current quarter coming in and looking favourable. Interestingly, Mark Benioff saying that it's not just the numbers of the current quarter, most recent quarter, that excite him. He said they were fantastic numbers. He says he's more excited about the prospects of this technology, these AI agents, as they're characterized, at least by Salesforce. They've hired an additional 1,000 people to try and sell them to their customers. He thinks there's real upside, as does, by the way, the analysts from JP Morgan, who say that forward guidance in terms of revenues and margins, those could be raised going forward on the back of what they're seeing at Salesforce.
Tom, it's interesting when you look at some of the calls. You've got Evercore and an outperform, Barclays with an overweight with a price target of $415. We just had a conversation with the OECD, the chief economist there, and he's talking about a real lift in efficiency from AI. This is about the ability to develop the product and sell it at a higher margin in that area, isn't it?
It absolutely is. It's about including those additional products for their existing customers and building out a customer base beyond the CRM, for which, of course, they are famous at Salesforce. They think they can expand into parts of this market that they have yet to touch. That's why when Mark Benioff talks about the future, he leans on this technology that they are investing in. And again, they are not seeing the full impact of this yet. It's the forward look on the potential for this that could be the real benefit for Salesforce going forward. Interestingly, on the AI piece as well, to sustain all of this, you need to have the energy there, and that's where the story around Meta comes into play. They have told developers to draw up proposals to have between 1 and 4 gigawatts of nuclear power ready for the 2030s. You cannot have Salesforce building their AI agents if you don't have the data centers training these models and if you don't have the data centers supported by energy. We know the energy piece is crucial. Mark Zuckerberg has spoken about this earlier in this year, saying that is the major headwind for the growth of AI going forward. Now he's putting his money where his mouth is on this front and looking to get potentially up to 4 gigawatts. 1 gigawatt, by the way, can provide power to about 750,000 homes or one mansion. Alphabet, Amazon, they're also doing this. Microsoft with Pennsylvania, and they're looking to invest. They've already done a deal in terms of reviving that nuclear reactor on 3 Mile Island in Pennsylvania. So big tech, the hyperscalers, they are trying to get the nuclear piece at play so they can have that energy surety in the years ahead.
Does that imply Manus's mansion is the size of like a city?
Can I just say the square footage in your average New York apartment is very, very different. So there's Mac mansions at home in Ireland, Tom, but I'm not in a Mac mansion, that's for sure.
You know what, Manus? This is what it is. An apartment in New York City is the same as a mansion in Ireland. Hey, Tom, thank you so much for your time this morning. That is Tom McKenzie there, Manus.
Yeah, let's just check in on these markets, Danny. I mean, we're knocking out 55 records in a row. That was yesterday. Can we bring that home today? $11 trillion in market valuation has been added so far in 2024. The 10-year yield ticks higher by 2 basis points this morning. We'll talk through what to watch on the slate in just a moment.
It's your Bloomberg Brief. Danny Berger alongside Manus Cranny in New York. Let's get you set up for your trading day on this Wednesday. We're going to have more earnings. Dollar Tree, Foot Locker, Campbell Soup, all of them report before the bell. Then we're going to hear from the big event. Fed Chair Jay Powell will be speaking 1:45 p.m. Eastern at a New York Times event. We're also going to hear from Christine Lagarde today. Plus, the Fed Beige Book, Manus, that will come out at 2 p.m. Those anecdotal sort of stories taking more importance for the Fed as of late.
Well, let's see whether the pace of Powell has changed and if he's in a bit more of a hurry from the data from the economy. Some stocks to watch. Dollar Tree, earnings before the bell. Bloomberg Intelligence expects a softer discretionary spend, pressuring the performance. You got Oracle, earnings after the market closes, supply issues in focus, and Merck raised to a buy at HSBC. The analyst there noting that the current valuation leaves a significant margin of safety in the valuation. So we're up 1%. Danny.
Meanwhile, Manus, the dollar keeps strengthening against more currencies. And what we're starting to discover is it's not necessarily just about pro-growth policies. It's also turning into one where political disaccord abroad is bringing money back into the U.S. and bringing money back into the dollar.
And I like what Mark McCormick had to say at TD, which is it's the burden of proof on the euro. Do you buy euro assets? Have you got enough conviction to buy euro assets? Because that's the only thing that's probably going to turn or pivot the euro-dollar trade.
Yeah, I don't know what gives people that conviction at this point. Anyway.
We give them hope.
Give them hope. That's it for your brief. Surveillance. We'll take it from here.